Ray Dalio's all-weather portfolio. YouTube loves it. TikTok loves it. It survives any market. That's the pitch. But here's the thing nobody tells you. We ran the actual numbers, 20 years of them, and what we found honestly surprised us. We're not a hedge fund. We're ordinary people with real data, so we backtested it properly, tested by ordinary people, for ordinary people. The experiment, $100,000, 20 years of real prices, real dividends, real trading costs, no shortcuts. Quick ground rules, because the how is everything. Real out of prices going back 20 years, dividends reinvested, trading costs subtracted. If a backtest skips the fees, it's not a backtest, it's a brochure. And none of this is advice, just numbers run honestly. So where does this come from? Bridgewater, Ray Dalio's fund, one of the biggest on the planet. The design is genuinely clever, but clever design doesn't guarantee returns. That's exactly what we wanted to see for ourselves. Here's the core idea. Dalio says the economy only has 4 seasons. Growth, stocks do the winning. Recession, long-term bonds hold you up. Inflation, gold and commodities keep their value. Deflation, quality bonds, again. Most people, without realizing it, bet everything on one season. Dalio's answer, don't pick. Hold all 4 and no single winter can kill you. That's the theory. The actual recipe, 40% long-term bonds, 30% stocks, 15% intermediate bonds, 7.5% in gold, 7.5% in commodities. Yes, more than half of it is bonds. This thing wasn't built to beat the market, it was built to survive it. And once a year, everything gets rebalanced back to these exact weights. Okay, 100 grand, invested at the start of 2006, 20 years, let's watch. Blue is all weather, white is the S&P 500. At first, basically twins, then 2008 hits. Watch the white line. The market loses more than half. And all weather, it barely flinches. Same crash, completely different story. After the bottom, everything recovers and the market starts climbing. Second half of the decade, the S&P pulls away and the gap keeps growing. 2000, COVID. A brutal drop, then a fast bounce. By 2020, the gap is huge. That safety came with a price tag. Then 2022. And here's the plot twist. Both fall together. The defense didn't work. Both recover, but the gap never closes. 20 years later, all weather turned 100,000 into about $386,000. The 837, more than double. But here's what the average hides, the crashes. Quick word. A drawdown is how far you fall from your peak. 2008, the S&P dropped 51%. All weather, 12, 2020, 20 versus 1. It kept its promise right up until 29-2 when both fell together for the first time. So what broke? The whole strategy rests on one assumption. When stocks fall, bonds rise. For 40 years, that mostly held. Bonds were the shock absorber. Then 2022, inflation spikes, the Fed slams rates up, and stocks and bonds sink together. The shock absorber just stopped. We're not trying to fix Dalio's strategy, we just wanted to know what actually moves the needle. Rebalancing 4 times a year? Basically nothing. You just pay more in fees. Swapping the long bonds for shorter ones? The 2022 hit shrinks and risk-adjusted returns improve. Leaning harder into stocks? You make more and you hand back the protection in every single crash. Every choice is a trade-off. There's no free lunch. One last thing, and honestly, it's the cleanest way to see this. That 20-year average is really 4 different stories. 2006 to 2010, the crisis years, all weather beat the market up 41% against 7. Then came the longest bull run in history, and the S&P more than doubled while all weather fell way behind. It protects you when markets fall. It holds you back when they run. That's the whole deal. So, the verdict. About 7% a year, with a worst drop of 21%. Is that bad? No. That's exactly what it promised. This is insurance, not a money printer. It keeps you invested when everyone else is panic selling because you were never taking that much risk in the first place. For now, it takes the top spot on our leaderboard, mostly because it's the first thing we've tested. Before you go, tell us what to test next. A famous strategy, a hidden gem, or the one you're running right now. Drop it in the comments. Thanks for watching, and we'll see you in the next one.